Okay, hey class, this is the lesson on balance sheets. So this video is about reading and making simple balance sheets. This is an introduction to the balance sheet. This video, I'm going to start by reviewing last lesson, and then we'll get to actually looking at some balance sheets and learning how to make them a little bit. Then we can practice it together once we've watched this and thought about it just a little bit. So last video was basically learning about assets, liabilities, and owner's equity. We learned that assets are economic resources that a company owns that are useful for helping generate revenue, such as cash, maybe debts owed to us, which we're going to learn are called accounts receivable, um, inventory, land buildings, trucks, equipment. Liabilities are debt obligations of the company, something that's owed. Okay, based on some past transaction that must be repaid. And we learned that owner's equity is the owner's claim to these assets, right? The owner's claim to the assets. And the reason why the owner's claim to the assets, the owner's equity, is equal to assets minus liabilities, is because, of course, our creditors are entitled to their debt that's owed to them legally. If the company fails, they are legally entitled to them. So the owner's claim over the assets of the business requires us to subtract what we owe. Okay, so I hope that makes some good sense right there. And another good way to look at it is just that assets of a business have to be financed somehow. Okay, a balance sheet, which we're going to learn right now, is useful because it lists all the assets and then it tells you how they're financed on the other side of the balance sheet. Assets, things that a company owns by definition, have to be financed either through liabilities, debt, or through the owner's equity, the owners of the business. One of the two, in some combination, has to basically fund all assets of a business. So that's something we can talk about as well. Whoops, I'm getting to learn this new system here. Let's look at balance sheets. So the big part of this lesson is learning what a balance sheet is and how to make it. So I encourage you to look at this right here. If you've done balance sheets before at a previous business class, this should be very simple today, very straightforward. But if you're in that seat, if you've seen a balance sheet like this before and you understand how to make this and how to read it, what I want you to start doing is thinking about what's the purpose of a balance sheet. Try to extend it to the next level. It's not going to be enough just to be able to sketch one of these up and sort of make up some accounts that fit your new business, like an entrepreneurship class or something like that. For this course, we're going to have to really get in depth. And the balance sheets we do throughout the course are going to get more complicated. Now, if you're new to balance sheets, this one might even look complicated right now, but I promise you in a week it won't. So there's, let's say, 3 sections to a balance sheet. Okay, so I think hopefully you can make sense of these given what we've done so far. There's the assets, which we put on the left of the balance sheet. And then there's the liabilities and owner's equity, which we're going to put on the right side of the balance sheet. Later in the course, you might see it listed vertically, like a balance sheet that has assets, then liabilities and owner's equity has 2 sections underneath it. That's like a vertical balance sheet. But for now, just to start things off, we're going to do this horizontal balance sheet because it's just like the fundamental accounting equation. Okay, so take a second, look at it, see if you can read it and make some sense out of it, especially if you're new to this. And I'll come back to this. We're going to talk about it, then I'll come back to this exact same balance sheet. So let's talk about the balance sheet. What is it? What are you looking at right here? Well, a balance sheet, first and foremost, lists a company's major assets, liabilities, and it also gives you a breakdown of the owner's equity of a business. So fundamentally, there's always going to be these 3 sections throughout this course. You might see different types of balance sheets later on, maybe a balance sheet for another type of business instead of a service business, maybe it's a merchandising business, or maybe it's a corporation instead of a private business, right? So we're going to see types of balance sheets. A balance sheet is a formal financial statement. Formal financial statements, we're going to do a couple of in the course. We'll do income statements and cash flow statements. A balance sheet reports the financial position of a business at a specific point in time. So there's 2 very important parts to this definition. That's all I'll talk about for the rest of the slide. First, it's financial position. I'll actually circle it here. And the second very important part of this is that a balance sheet is at a specific point in time. So think about what a balance sheet is. A balance sheet lists a company's assets. So let's pick a company. Let's say Amazon. We all know Amazon. Let's say you, as a student, you want to look up Amazon's balance sheet, which you can because they're a corporation, they're a public company. Balance sheet, we'll start with the assets section. And the first asset on Amazon's balance sheet is going to be cash. So Amazon's cash, whatever it is right now at 3:48 p.m. on this day, if 5 minutes from now I go on Amazon and I give them $20 and they're going to ship me a book, and maybe I pay them instantly in something that's equivalent to cash, then what could be said is that 5 minutes from now Amazon's cash will be plus, what did I say, $20 book will be plus $20. So in other words, 5 or 10 minutes from now, Amazon's balance sheet will look different than it is right now at this moment in time. So all that's my way of saying that if you're going to list out all the things a company owns and owes, that could change second to second, right? So we treat a balance sheet sort of like a picture. So this is my version of it. It's a really bad camera, but it's like a snapshot, right? It's like a still frame. It only applies to that moment in time, and it shows you what it was at a specific moment in time because that's the only practical way to do it. So that's really important. And the second thing I stressed here for what a balance sheet is it gives you the financial position of a business. Okay, the financial position of a business is really what a balance sheet is. So a business's financial position, again, will talk to you about what they own, what they owe, and give you that overall equity number. What you take from the financial position of a business depends on who you are. If you're a business student and you're just doing maybe a project, maybe you and your group, you have a cool new idea for Apple, and it's a very bold idea. It's very expensive. It's going to require maybe hundreds of millions in investment and research and development, maybe to make this happen. Looking at their balance sheet can give you an idea of whether their financial position suits a very expensive new idea. If you look at their balance sheet and you see, whoa, Apple has so many liabilities, and their equity might even be a negative number, which it's not. But if that's the case, you just got more information that you can use to help you make that decision. If you're a creditor and if a company such as Apple goes to you looking for cash, they're obviously going to want to see your balance sheet. They're going to want to see what's your current position. What does your company currently own in assets? Can we leverage those against the loan in some way? In other words, are you good for it? Is your company currently owing money to a lot of parties, in which case they might want to make the loan more expensive or even not give it to them as a creditor? So the financial position can mean a lot of different things, and we're going to look at that throughout the course. But this is what we're looking for. It's always important to look at a company's balance sheet. Let's just say in most relevant situations they're going to come into, and we can talk more about that later when possible. So looking again at the balance sheet, let's go back to this one and let's talk about how do you make a balance sheet. So there's a bunch of rules for how to make this. If you've already done this before, like an entrepreneurship class, if you know the rules about what order you put assets in, liquidity, what order you put liabilities in, basically term, if you know things about like what to underline, where to put dollar signs, you really don't need to watch this. Then you're good because that's all I'm going to talk about for the rest of this video. So I'll give you some kind of an option if this is an ad puzzle, so just stop right here. But for everyone else, yeah, if you haven't done it before, I'll try to be as quick as possible. So let's say you are making a balance sheet for the business Easy Rentals. So that's the name of the business. You start with a 3-line header, okay, as you will for all financial statements. So this is a balance sheet. So the second line of the header, you're going to put the I shouldn't put name again. The name of the statement. And this was the name of the company, is what I meant to say. And then the third line is the date. Okay, so the first rule on the next slide, let me just flash forward here, is this notion of a 3-line heading: business name, statement name, specific date. Okay, and again, because it's a balance sheet, you're actually putting down the date because again, it's a moment in time. So this was what Easy Rentals owned and owed on September 30th, 2000, and let's say 19. All right. If it's an income statement or if it's a different kind of financial statement that covers a period of time, if it's not like a snapshot, like a picture, then it would say maybe for the month ended because that's a different type of situation. But balance sheets always just say a single date because, again, it's just a snapshot of a moment in time. Okay, what else needs to be said? So next, you list your assets and your liabilities. So hopefully, after last lesson, you're comfortable with this notion of, I understand why these things are assets. Rental equipment, that's something a company owns, there's values. Buildings, land, supplies, cash. Hopefully, that all makes sense. I'll talk about accounts receivable and accounts payable in a second. Basically, it's just money owed to us or money that we owe to other people. That's what an account receivable versus an account payable is. But what order do we put these in when we list them? So if you were just given all of these numbers and you had to actually make a balance sheet, you'd have to know what order to list the assets in. The answer for assets is you list them in order of liquidity. Liquidity is how easily an asset can be converted to cash. And cash is already cash, so that's why cash always goes at the top of assets. So what do we mean by be converted to cash? Well, let's look at things like supplies, or if we had inventory on here. This is a service business, so they don't have inventory. Inventory is buying and reselling goods, and service businesses don't do that. But if there's inventory, that'd be right near the top of the list because inventory is very easy to turn into cash. Remember that example from last time of a shoe store. If the shoes that you haven't sold yet are your inventory, well, if we actually need to turn them into cash very quickly. If our company needs cash for some reason, we're in a bind, it's relatively easy to do that. We might have to maybe put them on sale or something like that if we want to sell them really quickly. But in any case, easy to convert to cash. Now, if we look at the bottom, things like land and buildings, these things, take a long time to convert to cash. So we'd say they're not very liquid. That's why they're towards the bottom of the list. And also, in terms of converting them to cash, it's not something you'd want to do. If you get to the point where you have to actually convert your land or your building into cash, it might make it impossible for you to continue doing business. The reason why we usually put equipment at the bottom below things like land and buildings is that if you're a business that runs on equipment, once you sell that equipment, you can't run anymore. Whereas you might be able to sell your building and just still rent the space and keep the equipment, but the equipment is what actually enables you to do your business. So that's why things like equipment are not very liquid. We wouldn't want to convert them to cash until the last possible minute because, again, they would negate the ability for us to do business. So those are assets. Liabilities are even simpler. So assets we put in order of liquidity, liabilities just put in order of term. So the liabilities at the top of the list are the debts that we're going to pay back first. And the ones at the bottom of the list are long-term debts. They're going to take longer to pay back. So items like mortgages, that's when we're taking out debt to, typically purchase real estate. Takes a very long time off. And it could be 10, 25, 35 years. So that would typically be the bottom, a long-term liability. Then things like accounts payable, these are just simple debts that we occur in the regular process of doing business. So for example, if we get, let's say, deliveries to our vending machine every 2 days, we might not actually pay them cash every 2 days. We might just pay them at the end of the month or at the end of every 3 months or something like that. So until we pay them, we consider it an account payable, but it's just a regular account. So we just put the name of the person we owe money to. So that's an account payable. It's when we owe money. And an account receivable is when money is owed to us. An account payable, of course, is a debt because it's just flat out a debt. And an account receivable is an asset if people owe us money, because we're just going to assume for now that we're going to receive that debt at a high likelihood of probability. Later in this course, we might get to talking about bad debts and how we can maybe adjust that with the contra account, but that's just later on. So hopefully that makes sense what an account receivable, what an account payable is. The other thing to note too is if you have to list these on, if you have to make your own balance sheet, once you're listing the accounts payable, like the names of the people you owe money to, or the names of the people who owe money to you as an account receivable, you do that in alphabetical order. You see BOA burns, supply repairs, but otherwise, yeah, assets in order of liquidity and liabilities in order of term. So what else needs to just be said here very quickly to enable you to do these balance sheets? Well, one thing you might notice is at the bottom of assets, we have total assets. At the bottom of liabilities, we have total liabilities. And this number, owner's equity, which we might think would be the last number we'd see on a balance sheet, actually is not. The owner's equity, we put under the owner's equity section, and we put the owner's name, comma, capital. So if Jay Salas, if he or she is the owner of Easy Rentals, the business, if it's just a single owner, let's say for now, we would just put down the name Jay Salas, comma, capital. And then here's that number. Total assets, 373 minus total liabilities, 140 equals owner's equity, 233. As you can see, those numbers I've circled, that all makes sense. And the last thing we put on a balance sheet, and this is where I'm going to end it, the reason we call it a balance sheet when you're making one is because, as I said earlier, this balance sheet is supposed to replicate the fundamental accounting equation, asset, the left side of the balance sheet, equals liabilities plus owner's equity. Liabilities and owner's equity. So just to make sure that it actually is in balance, we end by adding up our total liabilities and owner's equity together and we double underline it to show that total liabilities and equity, which is 140,000 plus 233,000, is equal to our total assets, 373. So this is just our way of showing that, hey, look, these two sides do balance. So we typically put these together on the same line at the bottom. Things like underlines and dollar signs we'll do together in class. Simply put, you just put an underline anytime, a single underline, anytime you're about to do math. Okay, so if we're about to add or subtract numbers in the same column, we put an underline. And dollar signs, we just put in one of two spaces. Dollar signs either go at the first number in a column, like you see here, here and here, these two numbers that my cursor is going over, or the first number underneath an underline. So as you can see here, we have an underline. So the first number underneath it gets a dollar sign. Okay, so this one doesn't have a dollar sign because it's not either the first number in a column and it's not the first number under an underline. There's no underline over it. Okay, so that's the rules for dollar signs and underlines. We'll talk about that in class. Okay, I'm going to end the video there because 15 minutes is longer than I'd like it to be. Hopefully everything I said makes some sense. A recap of what we did here was a review of the last video and making balance sheets. And just let me know if you have any questions. Thanks a lot for watching it through.